Hi, you're watching the Street.com TV with me, Simon Constable, bringing you your weekly metals update. Today, I'm joined by Lakshman Achuthan. He is Managing Director of the Economic Cycle Research Institute here in Manhattan. Welcome back to the Street.com TV.
Well, thanks for having me.
I want to talk to you a bit about gold today as it relates to the work you do predicting how the economy moves. Mm-hmm. So I know that the gold pretty much reacts to two major things that you work on. One of those is the dollar, mm-hmm.
whether
it's weak or whether it's strong, mm-hmm. and the other is inflation.
Mm-hmm.
The other, I guess, really doesn't affect you because it's political risk, so we'll just deal with those two.
Okay.
Where do you see the dollar going?
Well, right now, it's certainly from a cyclical perspective, either from what's going on with inflation or with growth cycles in those two areas, it's somewhat supportive of the dollar. And what I mean by that is that we have inflation, the inflation cycle, fairly under control. Looking at leading indicators of inflation.
That's not the current ones.
Not the current.
All the food's going sky high in the shops.
And that's all coincident indicators.
Okay.
Those are all coincident indicators. I'm talking about leading indicators of inflation like the future inflation gauge, which we update each month. And this indicator has been trending down. It's in a mild downtrend.
And it's at like a 2-year low?
It's at a 2-year low as of the latest reading, pointing directionally to milder inflation for the next few quarters. But without even going that far, the simple message is there's no inflation spiral on our doorstep. And that's a big scenario that can be rejected based on this leading indicator of inflation, the future inflation gauge. And so that's somewhat supportive. On the growth side, we've been looking at an economy in terms of leading indicators, and I think we're starting to see it in the coincident measures, an economy that is more resilient and stronger than people had thought it would be. And
okay.
We're continuing, even the Fed today was coming out and saying, we still think things are on track and some of the risks that we were afraid of may be actually diminishing a bit.
So low inflation, good growth, that sounds pretty much like a Goldilocks scenario,
yeah.
Which that would be bad for gold.
Well, yeah, because to the extent that gold is more of a safety position to take when things aren't going well, what we're saying is, hey, things are going to be going well. I don't know if I would go all the way to Goldilocks. I would say Goldilocks with a few blemishes. There are a couple of bumps in the road here, and certainly, housing is one that's working its way through, for example. But it certainly is a fairly positive cyclical outlook. I mean, the risk of recession or inflation going out of control, those are minuscule at this point.
Now, what if one has one's gold component in one's portfolio?
Yeah.
Probably time to lighten up on it a bit now, perhaps?
Well, now, I hate to do this to you, but if we step back and look at the bigger picture, beyond just a few quarters, I would make the following comments that we should keep an eye on. One is that there's no recessions anywhere around the world.
Okay.
So we're into the 4th year of synchronized global growth. Tends to, at some point, give us some inflation, although it may be down the line.
So big risk a bit further off the...
Yeah, it's over, beyond the horizon.
So maybe don't lighten up then and just stay pat.
Yeah, I think that, certainly it has to be somewhere in your portfolio. You can't ignore gold as an asset completely, and there's a reason for it, but it may be beyond the sight of leading indicators. Leading indicators are relatively short-term leading indicators. They can look out a few quarters.
So not bearish, not bullish, about the same. Sounds pretty good.
Well,
thank you for joining us.
Thank you.
You've been watching the Street.com TV with me, Simon Constable, and Lakshman Achuthan, Managing Director of the Economic Cycle Research Institute here in Manhattan. Stay tuned for more.